Hey everybody, it's Jeff McDermott from Create Wealth Financial Planning, and today we're going to talk about some of the key provisions in the OBBBA, or the One Big Beautiful Bill Act, the big tax legislation that was passed into law this July 2025. This bill addresses a lot of the provisions that were set to sunset or go away in 2026 from our last big tax package, the Tax Cuts and Jobs Act of 2017. Now there's quite a long list of provisions in the OBBBA. I'm not going to hit on all of them here. I'm going to talk mostly about the ones I think will have an impact on the largest percentage of U.S. taxpayers, probably will have some impact on many of my own financial planning clients. So it's not going to be a deep dive with lots of little minute detail either. It's going to be high-level information, so if you see something that you think might apply to you, that can be an opportunity to learn a little bit more and see if it fits. There's a lot of information out there you can read on the various provisions. Some of the items I'm not going to talk about necessarily in this video. So my goal is just to raise awareness of the big ones and talk about a couple others that are somewhat interesting. One other important note, I'm not a CPA, I'm not an enrolled agent, I'm not a tax preparer. These are all presented through the lens of a financial planner with an eye towards optimizing your long-term situation, but do review any specific actions with your tax preparer before you make any big changes. All right, so let's start talking about some of the provisions in this bill. The larger standard deductions that were put in place in the 2017 tax package are now permanent. So at least until some future Congress decides they want to change things. But starting in 2026, single taxpayers, the standard deduction will be $15,750. For married taxpayers, $31,500. And something new, if you are age 65 and up, an extra $6,000 per person of standard deduction on top of what you already claim. That does phase out though based on income. That is also only through 2028. You'll find a lot of these provisions, not all of them, are only through 2028 or 2029, at least as of right now. But the big standard deductions stay in place, bigger standard deduction for a few years for age 65 and up. Now, another big one that's going to affect a lot of folks and prevented a lot of people, especially in high tax states, from itemizing and getting that little bit of extra deduction is the change or the increase in the state and local tax deduction cap, aka the SALT cap. That amount was raised from $10,000, where it currently sits. The most that you could deduct in state and local income taxes toward your itemization was $10,000. That is now $40,000 and will increase by 1% per year through 2029, and then at least as of now in 2030, it reverts back to that $10,000 cap. But that opens up more ability to itemize for a lot of folks with states with high income tax, sales tax, high property taxes. So even taxpayers in states like Texas with no property tax, with no income tax, tend to have high property taxes. You might have now a window to itemize there, depending on how much your property tax is, what other deductions you might have. This also does have a phase out for taxpayers with $500,000 or more in adjusted gross income, and the mortgage insurance premiums that you might pay if you put less than 20% down on your house are now also able to be included in your deductible interest if you itemize. So some big changes to itemization for taxpayers, especially with those with big tax bills that were capped at 10% in the past. There's also some changes in charitable contributions. So one thing is that a lot of taxpayers weren't able to take tax deductions for charitable contributions because of the big itemization hurdles. So a new rule, that's actually a rule that's being brought back that was around in 2020, allows taxpayers who don't itemize and who make cash donations, cash charitable contributions, to take a deduction of $1,000 for single taxpayers and $2,000 for married taxpayers. So start collecting those receipts that you might have been throwing away because you said, I can't itemize, there's no point with the charitable deduction. But that's back. You might remember in 2020, there was a 1-year rule that allowed $300 in individual taxpayer contributions or $600 joint taxpayer contributions to be deducted. And it's back $1,000 and $2,000, specifically for non-itemizers. So a couple of planning notes on these items around the deductions and the charitable contributions. Again, some of these measures are temporary. The itemization ones might allow you to recognize additional income now at a lower tax rate if you can fill in that gap that the additional deduction creates. Some deductions like the state and local income tax deduction might encourage bunching deductions like paying 2 property tax bills in the same calendar year or pulling forward a property tax bill into the current year when this law is set to sunset later down the road. And also keep in mind, if you are approaching a phase-out threshold, like you are a 65-year or older taxpayer and you're getting close to that $150,000 in adjusted gross income, additional income might have a bigger tax impact than just your tax bracket. So we might think twice about additional IRA distributions or things like that if it looks like you're going to increase your income tax and lose deductions on top of it. Interesting note, the state and local tax itemization rules don't differentiate single versus married filers, so there's kind of a marriage penalty built into that as well, where a single taxpayer can deduct just as much as a married couple. All right, some other provisions in this bill that are interesting to talk about: sports bettors and other gamblers. So gambling losses, which also have to be itemized, now have a limit on 90% of losses that could be deducted or offset other gains. So it kind of creates an interesting situation where someone might have $100,000 in gambling wins, $100,000 in gambling losses. Because you can only deduct 90,000 of those losses, you would still report $10,000 of gambling income, even though you basically broke even. There's also a new auto loan interest deduction, which is through 2028 on new vehicles with new loans put in place after December 31st of 2024. And there's limitations here. It has to be a certain kind of personal use vehicle, must be assembled in the United States, which is a tricky question given the global assembly a lot of vehicles go through, but there are some resources out there to help determine what qualifies. And it's capped at $10,000 of interest per year with a phase out for high earners. Again, that's through 2028. So if you are buying a new vehicle and it does qualify, make sure you get your deduction on that auto loan interest. A lot of publicity around the no tax on tips and no tax on overtime, both of which are also temporary. They run from 2025 to 2028. Now remember, tips and overtime with certain limitations are exempt from income tax only. You'll still pay payroll taxes, Social Security and Medicare taxes, just income tax exemption. There's also limitations on how much can be exempt. There's phase outs for higher earners. Overtime exemptions are only an exemption on the differential between your regular pay and the overtime pay amount. And the tips provision, a lot of folks that collect tips and are going to benefit from this are in low tax brackets already. So it kind of remains to be seen to me what actual value will be delivered from these deductions for tips and for overtime. But if that's how you get paid, if you get income from those sources, make sure you're tracking it and reach out and get this deduction if you're eligible. Money's money. Okay, quick lightning round of a few other provisions that are worth noting. Standard child tax credit, great news for families. It's increased to $2,200 and will increase with inflation every year from here on out. Still has a phase out that starts at $200,000 in AGI for a single taxpayer and $400,000 for joint taxpayers, not indexed for inflation. So unless that changes, more people are going to get this deduction or this credit phased out over time. 529 educational account expenses have been expanded. There are more types of expenses and a larger amount of expenses you're allowed to put towards K through 12 schooling expenses, and professional certifications like a certified financial planner, education program and exam are also eligible for 529 expenses. So those professional certifications, always nice to see more use cases for that 529 money. The estate tax exemption is now $15 million per person before you owe estate tax or gift tax, and increasing for inflation every year. Again, at least for now, another Congress could decide to change that. And the last thing I want to talk about today are the clean energy credits that are being repealed and phased out rather quickly. So if you have a plan to purchase an electric vehicle or make some energy improvements around the home, you want to look at this and you want to do that quickly if it's already in the budget. The clean vehicle credit is ending for vehicles purchased after September 30, 2025. So only a couple of months to go on that one. The alternative fuel vehicle refueling property credit for charging equipment you install in your home is being phased out and eliminated for equipment not put in service before June 30, 2026. So you have to get that done before June 30, 2026. And the energy efficient home improvement credit for energy efficient windows, doors, air conditioners, water heaters, and the residential clean energy credit for things like solar panels, fuel cells, etc. Both have a December 31st, 2025 deadline to be aware of. So look into that if you're considering any of those purchases. So those are some of the bigger provisions on the bill, at least in my opinion. There's a lot of things in there for small business owners, some other little things here and there, but what we're going to see on a widespread basis and things that are being phased out pretty quickly, I think we're seeing that with today's video. Please, if you have questions at all, reach out. Let me know what you'd like to know more about or how I can help, and schedule an intro call if you'd like to talk a little bit more about your personal financial planning. Thanks again, and I'll talk to you soon.